Subscribe to my channel Report Stock.
Welcome to the Deep Dive. So today we're digging into something pretty interesting, a bit of a paradox actually, from the luxury world. How does a brand like Ermenegildo Zegna, a real high-end player, handle these turbulent economic times we're in? Especially when their latest numbers show organic revenue actually dipped. We're looking at ZGN NV's half-year 2025 performance. And yeah, organic revenue down 2% to EUR 928 million. But, and this is the kicker, their net profit, it shot up by 53%.
Crazy, right?
Hitting EUR 47.9 million. So how on earth do they pull that off? What's really going on behind those numbers? Let's unpack this.
Yeah, it's fascinating, isn't it? Because understanding how Zegna managed this, well, it gives you a real shortcut into the, let's say, the complexities of high-end fashion finance right now and, market volatility too. We're basically going to dissect the highlights from their earnings call, figure out the key drivers, but also, importantly, the challenges they're facing. It tells you a lot about the luxury sector overall.
It really does sound like a story of smart adaptation. Okay, so let's start with that massive profit surge, 53%. Even with revenues falling slightly, the initial reports mentioned higher financial income and some helpful foreign exchange gains being big factors.
That's definitely part of it. Yeah, higher financial income, favorable currency movements, those certainly help the bottom line. But there's a really important operational story underneath. Look at their gross profit margin. It improved by 110 basis points.
Okay, so 1.1 percentage points.
Exactly, reaching 67.5%. And the CFO was quite clear on this. It was driven mostly by a better channel mix, specifically the bigger share coming from direct-to-consumer, DTC.
Great.
That's now, get this, 88% of their sales.
88%.
Huge, right? Plus, they've really doubled down on selling at full price and pushing personalization. That's the core strategy shining through.
That 88% DTC figure, that feels massive for luxury. It's more than just a trend. That sounds like a fundamental shift for them. What advantages does that give Zegna right now? Especially, when the overall market might be a bit shaky.
Oh, absolutely pivotal. It's all about control. DTC means they keep more of the margin, right? No wholesale cut. But maybe even more critical is the direct line to the customer. They get the data, they can personalize offers, tell their brand story directly, test things faster. In a choppy market like this, that direct relationship is, well, it's gold. It lets them hold the line on pricing and build loyalty.
Right, so focusing on how they sell, that DTC channel seems like a huge win for the main Zegna brand itself. But does that success translate across their whole portfolio? Or are we seeing different stories for, say, Thom Browne or Tom Ford fashion?
Good question. Because no, it's definitely not a uniform picture. The Zegna segment, very strong. Adjusted EBIT margin up 150 basis points to 14.3%. They mentioned better operating leverage, tight cost control. They're aiming for 15% long-term there. But contrast that with Thom Browne. Its adjusted EBIT basically collapsed, fell from EUR 20 million down to just EUR 4 million.
Ouch. Why such a big drop?
Primarily a big hit from declining wholesale revenues. It really shows the risk if you don't have that strong DTC presence as a buffer. Plus, selling costs went up. And then Tom Ford Fashion actually posted a loss, an adjusted EBIT loss of EUR 19 million, though that was partly planned, investing in new stores, IT systems.
Okay, so it's a mixed bag. Some strategic pain alongside the Zegna brand strength. You mentioned cost selling, general and admin, the SG&A. Those went up as a percentage of revenue to 54.1%. You said negative operating leverage, but also investments for growth.
Exactly. Lower revenue on a similar cost base hurts leverage naturally. But they were also clear that some of those costs are, necessary investments for the future. But even with those pressures, they seem really disciplined elsewhere. Inventory management, for instance.
Right, I saw that. Trade working capital actually went down from 467 million to 442 million euros.
Yeah, that's a good sign. Shows they're managing stock efficiently, not getting stuck with unsold goods, which can be really costly. And all this financial caution, this discipline, it feels like it stems from them being pretty wary about the wider world, especially certain regions.
That really came through. They sound very cautious about the, quote, challenging external environment, particularly the ongoing weakness they're seeing in Greater China, the GCR. They actually used the phrase, planning for a new normal scenario, not banking on a China rebound. That phrase, new normal, that really stands out, doesn't it?
It absolutely does. It suggests they see this not just as a blip, but potentially a longer-term shift they need to adapt to permanently, not just waiting for things to bounce back. And related to costs, they also mentioned small price increases, low single digit, mainly in the US, to offset costs and tariffs there.
Makes sense. So looking ahead for the full year.
They're sticking to low single-digit organic growth expectations, and the market consensus seems to be around EUR 173 million for adjusted EBIT in the second half, which they termed realistic.
Okay, so pulling it all together for you listening, what we see here is Zegna showing, well, real resilience, adapting strategically. They're using that DTC lever, controlling costs very tightly, and managing to boost profits significantly, even while that top-line revenue faces pressure. It's quite the balancing act.
And if you connect this to the bigger picture, Zegna's experience, it's almost a case study in navigating this kind of market volatility. It really highlights the power of having different brands, sure, but critically, the power of that direct-to-consumer channel. It gives you control when global markets feel, well, unpredictable.
Definitely. Which leads us to a final thought for you to chew on. In this kind of volatile global economy, how should luxury brands weigh prioritizing profit margins and these strategic long-term investments versus chasing immediate revenue growth, especially when facing major regional headwinds like Zegna sees in China? What lessons can you take away from Zegna's half-year about building resilience against unpredictability? Something to think about.
Subscribe to my channel Report Stock.